Trent Bradshaw, Brandon Rogers with Bradshaw Financial Planning and Mind Your Money. Today's June 3rd, 2021, and we wanted to bring you a market update pretty much year to date.
Yeah.
A couple things we're going to talk about on the agenda today. Obviously, market update number one. Secondly, we're going to touch on foreclosures and the eviction moratorium that we're currently seeing. Third, we're going to talk about unemployment benefits and when those are going to end and what kind of impact that'll have on the economy. And then last, we're going to touch on the portfolios and what we foresee going into maybe reallocations here at first week in July.
Yeah.
Okay? All right, let's jump right in. Let's talk about market update, where we're at so far year to date. Market's actually doing really, really well.
Doing really good. Yeah.
Surprisingly, though, the leader from last year, technology, is actually the laggard this year. It's not doing as well, obviously, compared to other industry groups that we're focused on, like energy and others. Energy actually happens to be the leader year to date. But overall, the market's doing well. The one thing that we're focused on, the Federal Reserve are still pumping in $120 billion a month in liquidity, buying U.S. Treasuries and also mortgage-backed securities. So as long as that liquidity is being pumped into the system, then we feel that's a positive for the market and actually what has caused the reaction so far year to date. Very important though, the liquidity may be cut back quite a bit as we head into the end of June, into July, because of unemployment, which we'll touch on in just a little bit. All right. Secondly, let's talk about the foreclosure and the eviction moratoriums that we're faced right now, Brandon.
Which too, I know we just did a podcast on that that's really interesting, so you certainly want to go check that out as far
absolutely.
as the housing and what that looks like. It's really, really, really good. So.
Yeah, the podcast was with Diane Green, local real estate company owner, and also specialist, and really laid the groundwork for what we're getting ready to potentially see.
Yeah.
They're talking about, the impact of the moratorium ending here at the end of the month could impact up to 11 million families nationwide. Mm-hmm. Now, if that happens and they can't afford to stay in the homes, then obviously the inventory of real estate and homes in this country are going to skyrocket, which potentially could put the brakes on this appreciation that we've been seeing in real estate prices, which is exactly what Diane was talking about when we did the podcast. So again, if you haven't listened to it, go back and listen to that podcast in regards to real estate. Found it very, very informative. Okay. Third, let's talk about the unemployment benefits, the enhanced unemployment benefits that we have right now. When is that ending?
Yeah, should be ending this month, at the end of this month, or fully from that end. So
some states middle of the month, but end of the month.
Yes, you got federal programs, you got state programs. So some states are, I think Texas and Florida have been kind of just.
It's 24 or 25 states now.
Yeah. So it would be interesting to see. North Carolina especially is trying to. There's a bill that's actually just passed the House that they're trying to incentivize people to go back to work. So obviously, it's trying to get people out of the house, hopefully feeling comfortable and getting back to work so we can get this economy back going again. And they're trying to offer, say, $1,500 for an individual if they go back to work, let's say within a 30-day time frame, but they got to stay employed for 4 weeks. So that's a pretty interesting tactic. I guess the government was giving some handouts to put us in this situation to help people out because they really needed it. Now they're trying to reverse it and get people back to work.
Well, it's kind of a weird environment out there right now. I've never seen this. I've saw it. I actually read an article and actually saw that companies like McDonald's are offering up to $1,000 in bonuses to people to come back to work or become employed, obviously, with the company. Yeah. But in addition to that, some companies are offering iPhones after 90 days. So that's basically a $1,000 expense too. But I don't think I've ever seen this to get people to come back to work, but there is a positive spin to this. When these enhanced benefits end, people are going to have to go back to work. And when they go back to work, the employment numbers are going to look great.
Yeah, jobless claims have been slowly getting better too as well. Every week that kind of number comes out, so we've been following that. So that's still trending in the right direction, but definitely has a long way to go.
Well, keep your eyes on those numbers. Obviously, we'll bring you updates. But we do foresee that to improve greatly because people are going to go back to work because unless they're planning on moving or leaving their homes right now, they've got to have the monies to be able to pay those mortgages now going forward.
Absolutely.
Talk about the overall potential reallocations, just general portfolios like we've got them now, and what we see going forward.
Yeah, so currently right now, again, we're obviously in the market from that end. We're overweighted in some financials, industrials, energy. Again, as Trent mentioned, energy's been the best performing sector of the market. So a lot of people probably didn't really think that going into the year with basically the new Green Deal plans and stuff like that. But energy's been fantastic.
I think energy's up like 45.5% year to date.
It's over crazy. 40%. It's pretty wild.
Last year's the worst performing industry group though. Last year's the worst. This year the best.
But then also too, as he mentioned before, was you got this rotation going on. Tech stocks did fantastic during the shutdown. Mm-hmm. So what we've seen is obviously that rotation from technology being down. But they're rotating back into the overall market, which is a positive. So as long as they're not going to the sidelines, we're good. So those are all positives. As far as the additions or any changes to the portfolios, again, having those reallocations July 1 might be adding consumer staples, utility stocks. Basically, what we're getting back towards is the overall dividend payers. So they usually perform well during those times.
And really, the reason behind that is we're starting to see evidence of the economy slowing quarter over quarter, which is expected because if you go back to the second quarter of last year, where were we at? Well, everything was shut down. Yeah. So the quarter that we're in right now, the second quarter, is probably the highest growth that we're ever going to see. It was incredible, 50%, year over year. So it's pretty massive. But going into third quarter, that's going to slow, and that's one of the reasons we look towards actually the laggards this year, which would be consumer staples and utilities.
Yeah. So we definitely see some opportunity there going forward. We'll keep continuing the second half of the monitoring the market from that end. We'll look at say what happens to taxes rates in the future. Hopefully, we got a better idea what's that's going to look like in 2022. But again, as always, we'll keep you up to date. Let us know if you've got any questions. Reach out to us anyway. Check out our podcast. We're on every major platform. Our website has links to them. We've got more videos and educational sources. So again, we're big on education. So definitely check those out. So we appreciate you joining us today. I'm Brandon Rogers, Trent Bradshaw with Mind Your Money.